Are you wondering what might happen to your interest rate if you've already locked it, but rates improve before you actually close? If so, then this is going to be the video that you want to check out. Now, what happens in most situations is when you go to lock your interest rate, you should be having a conversation with your lender about what is going on in the market. How volatile is it? Where do we anticipate that rates are going to go? And taking that in combination with your own risk tolerance to make as educated of a guess as possible as to whether or not you want to lock the rate and have it set right there, or if you want to continue to float and see if the market improves or not. Now, assuming that you were to lock the rate, but you're not closed on your loan yet, and the market actually improves, there may be a couple options to take advantage of that, which in my opinion is probably pretty kind of the lenders, just because if rates were to increase, the lender is not going to come back to the borrower and say, hey, I know we agreed on this over here, but we're going to retrade on our agreement, and now we're going to charge you something higher. However, we do often see that borrowers will come back and say, yeah, I know we agreed on this rate over here, but the market got better, so we want to take advantage of that improvement. So in order to account for this, a lot of lenders will have what we either call a float-down policy or a rate renegotiation policy or guideline. Now, first, this is something that will and can vary among each lender. They're going to set their own guidelines for this type of policy. And there are some common things that they may keep in mind, but again, make sure that you know with the lender that you're working with if they do or do not have one of these policies in place in an improving interest rate environment. Some commonalities among them might be that you need to be through underwriting first, meaning they want to basically know that this loan is going to close before they go and spend more money to renegotiate on a lock or anything like that. Also, they may not give you the full difference or the full benefit. So for a pure example case, let's say that rates are in the mid fives and then they come down closer to 5 or somewhere in the high 4s, maybe something like that. And rather than giving you the benefit or the borrower the benefit of going all the way down to what it would be exactly today, they might either meet you halfway or give you, a certain amount of that improvement. That way they're not out of pocket for the entire cost and everybody still gets to win to some extent. And then another thing to keep in mind is that in some cases, they may require you to close within a certain number of days once that renegotiation policy has already been set and has been established. And then finally, you will only be able to do this once. This is probably the most common feature among these, that they're not going to give you every little bit of improvement along the way. If you are in the very beginning of this process and you've already taken advantage of it once and the market continues to improve, it is likely that you won't be able to take advantage of it again. So it really is a thing where you need to assess your risk parameters, your risk tolerance, have a conversation with your lender, make an educated decision to the extent possible, because none of us have a crystal ball that we can go and look at and tell you exactly what interest rates are going to do. But if you find yourself in that position, it's certainly worth asking to see if you are able to take advantage of a rate renegotiation or float down option.